The complete forensic playbook. Companies spend millions on cybersecurity to stop hackers from breaking in. Meanwhile, employees are walking money out the front door using the payment systems companies built for them. I'm Dr. Fulmore. Lock in. You've approved Venmo requests without reading them, right? Someone sends you a request, you see a familiar name, you tap approve, 3 seconds, done. You're trusting the system, trusting the person, trusting that nobody would abuse something so simple. That's actually sophisticated transaction, verification thinking. You're doing mini fraud risk assessments every time you pause before hitting approve. Here's what's interesting. You probably verify your $23 Venmo request more carefully than some companies verify their $23,000 payments. You'll check who's requesting, why they're requesting, and whether the amount makes sense. But companies processing hundreds of invoices daily, they're assuming legitimacy until someone proves otherwise. That assumption is the vulnerability we're exploiting when we study cash disbursement schemes, because the numbers tell a story about who's paying attention and who's getting robbed. Every fraudulent payment leaves traces, patterns in timing, amounts, documentation, and behavior. Today we're learning to read those traces before they become headlines. To know accounting, you must do accounting, and today we're doing forensic analysis on the most common occupational fraud category. Let's build. Cash disbursement schemes are fraudulent payments flowing through an organization's legitimate payment processes, appearing completely proper until someone actually investigates. According to the Association of Certified Fraud Examiners, these schemes account for roughly 45% of all occupational fraud cases and cause median losses around $100,000 per incident. This isn't someone breaking into safes at midnight. This is someone using company systems, procedures, and authority to steal money during business hours while everyone watches. The brilliance is camouflage. When fraud looks exactly like regular business activity, it becomes invisible. A fake invoice processed through accounts payable looks identical to a real invoice. A forged check moving through reconciliation triggers no alarms. A ghost employee on payroll appears as just another name on the spreadsheet. The fraud hides inside the legitimacy of normal operations, which is why detection requires more than casual observation. It requires systematic analysis. These schemes fall into 5 major categories: billing schemes involving false documentation, check tampering through physical manipulation, payroll fraud creating false compensation claims, expense reimbursement schemes, claiming illegitimate costs, and register disbursement fraud at point of sale. Each exploits different weaknesses in how organizations move money from their accounts to external parties. And here's the foundation. Every single one requires the fraud triangle elements we've studied: pressure motivating the fraud, opportunity enabling execution, and rationalization justifying the theft. Remove any element, and the fraud collapses. That's our job: systematic fraud collapse. Billing schemes involve using false or manipulated documentation to cause legitimate-looking payments that flow through standard organizational channels. The fraudster creates or alters invoices, purchase orders, or receiving documents to make fraudulent payments appear as routine business transactions. The disbursement gets processed through normal accounts payable procedures, approved by supervisors, and paid through established banking channels. Everything looks proper, except the underlying transaction is fiction. Think about how you process information online. Someone sends you a professional-looking email with proper formatting, correct terminology, and an official-seeming domain. Your brain assumes legitimacy based on appearance. That's exactly how billing schemes work. They exploit the human tendency to assume properly formatted documentation represents legitimate transactions. Accounts payable clerks reviewing 200 invoices daily aren't investigating every vendor's authenticity. They're verifying that documentation matches policy requirements. Format compliance becomes a proxy for legitimacy, and fraudsters know this. Here's what companies struggle with: speed versus security. Business demands fast payment processing to maintain vendor relationships and capture early payment discounts. But fast processing means fewer verification steps, You can't simultaneously review every invoice thoroughly and process 500 invoices daily with a 3-person AP team. That's not a resource allocation problem. That's a mathematical impossibility. So companies choose speed, accepting fraud risk as the cost of operational efficiency. That calculated trade-off is where billing schemes live, in the gap between what should be verified and what actually gets verified. The historical context matters. Luca Pacioli invented double-entry bookkeeping in 1494, specifically because Venetian merchants were being robbed by bookkeepers who recorded payments that never occurred. 5 centuries later, we're fighting identical fraud with more sophisticated tools. From the past to the present, we account for progress and for the people who exploit our trust in processes. Shell company schemes involve creating fake business entities, complete with business names, tax identification numbers, bank accounts, and sometimes even websites, for the sole purpose of receiving fraudulent payments from employers. The fraudster becomes both employee and vendor, submitting invoices to themselves and either approving those invoices through their position or manipulating supervisors into approving them. The creation process is absurdly simple. You can incorporate a business online in under an hour for less than $300. Legal services like LegalZoom and state filing websites make business formation accessible to anyone. You file articles of incorporation, obtain an employer identification number from the IRS, open a business bank account, and you're operational. Everything legal until you start using that entity to steal. If you're sitting here thinking, wait, I could create a business during lunch? Yes, you absolutely could. The system doesn't ask, but will you use this for fraud? It just asks for your filing fee. Shell company schemes work through several mechanics. In self-approval scenarios, the employee has authority to approve invoices, so they submit invoices from their shell company and approve them personally. No conspiracy required. They're the submitter and approver. In schemes involving weak documentation and supervisory review, the fraudster submits vague invoices for consulting services or advisory work that supervisors approve without questioning because they assume someone else verified the vendor's legitimacy. Everyone assumes someone else checked, so nobody actually checks. Pass-through schemes add sophistication. The fraudster creates a shell company that buys goods from legitimate vendors at actual cost, then resells them to the employer at inflated prices. For example, Dell sells laptops for $1,000 each. The shell company purchases them and invoices the employer for $1,500 each. The employer pays $1,500 to the shell company. The shell company pays $1,000 to Dell, and the fraudster pockets the $500 markup per unit. This is harder to detect because Dell is a legitimate vendor. Actual products get delivered, and the shell company appears to be a legitimate distributor. Here's what's wild. Some employees run shell companies for years, paying themselves monthly, even paying taxes on the stolen money to avoid IRS scrutiny, all while their supervisors think these are legitimate vendors. They're so committed to the fraud that they file accurate tax returns on stolen income. That's dedication to the craft. At major retailers, investigations have uncovered shell companies billing for services that were supposedly performed, but no one can remember ever receiving. The fraud hides in organizational complexity. When you have 10,000 vendors, who's verifying that vendor 7,341 actually provided the services they invoiced for? Detection requires systematic controls and analytical techniques. Organizations should maintain approved vendor lists with verification requirements before adding new vendors. Background checks, physical address confirmation, business license verification, and reference checks from other clients. But here's reality. Most companies add vendors casually because business moves fast, and nobody wants to be the bottleneck who delayed an urgent purchase. Key red flags to watch for include vague invoice descriptions like consulting services, miscellaneous supplies, or professional fees without detailed scope of work. Legitimate vendors itemize. Fraudsters stay vague because specifics invite questions. Watch for similar amounts across multiple invoices: $9,800, $9,750, $9,900, all clustering just below approval thresholds. Real business costs vary naturally. Engineered amounts signal strategy. P.O. boxes instead of physical addresses are suspicious. Some legitimate small businesses use P.O. boxes, but major vendors have physical locations. If a consulting firm invoicing $50,000 monthly lists a P.O. box as their only address, that warrants investigation. Cross-check vendor addresses with employee addresses. Matches indicate potential shell companies. This simple control catches huge amounts of fraud, but many organizations never implement it because it requires integrating HR and AP databases. Data analytics techniques transform detection from sampling to population analysis. Trend analysis examines vendor payment patterns over time. A vendor whose payments increase dramatically without corresponding business justification might be fraudulent. Duplicate payment analysis identifies identical amounts paid to the same vendor on different dates, suggesting the same invoice was processed multiple times. Vendor ratio testing compares new vendors to total vendor population. If 30% of your vendors were added in the last 6 months, that's unusual and warrants review. You already use analytical thinking like this. When you're scrolling social media and suddenly see 5 different accounts posting identical content about a sketchy product, your brain flags it as coordinated fraud. That's pattern recognition. We're applying identical cognitive tools to financial data, just more systematically. At a Fortune 500 company I consulted with, we ran analytics showing one vendor had been added to the system on a Friday afternoon and received their first payment the following Monday for $47,000. That's suspicious velocity. Investigation revealed it was a shell company created by an employee who had approval authority. The speed from vendor creation to payment was the tell. Legitimate vendors have lag time, while contracts get negotiated and services get performed. Non-accomplice vendor schemes manipulate relationships with legitimate vendors without the vendor's knowledge or participation. The fraudster exploits existing vendor relationships, changing payment addresses, inflating invoices, creating duplicate payments, or billing for services never ordered, to redirect money meant for real vendors into accounts they control. The vendor is oblivious that their business relationship is being exploited for fraud. Think about splitting costs with roommates. Someone collects everyone's money for utilities, but inflates the actual cost. Yeah, the electric bill was $200 this month, when it was actually $140. They collect $200 from roommates, pay the utility company $140, pocket the $60 difference. The utility company has no idea. Your roommates think they paid the correct amount. The fraud lives in the gap between stated cost and actual cost. That's non-accomplice vendor fraud at microscale. Companies experience this through several methods. An employee with access to the vendor master file changes payment addresses for established vendors to P.O. boxes or addresses they control. When the company pays a major bank's legitimate invoice, the check goes to the wrong address. The bank never receives payment and sends another invoice. The company pays again. Meanwhile, the employee is cashing the first check. Or consider invoice inflation. Employee receives a quote from Dell for $50,000 worth of computers, alters the quote to show $65,000 using basic editing software, gets approval for the inflated amount, then negotiates the original $50,000 price with Dell. Company pays $65,000. Dell delivers $50,000 worth of product, and somewhere that $15,000 difference gets diverted. Dell received exactly what they invoiced. The company paid exactly what was approved. Perfect crime until someone audits. Another variation, employee orders from a legitimate vendor but inflates quantities on receiving documents. Company ordered 100 units at $50 each for $5,000 total, but the receiving document shows 150 units received. The payment of $7,500 gets approved based on the false receiving document. The vendor gets their legitimate $5,000, and the employee diverts the excess $2,500. The fraud exploits weak controls between purchasing, receiving, and payment functions. Here's the absurd truth. Companies trust established vendor relationships so completely that they stop verifying. When you see an invoice from Microsoft, Amazon Web Services, or Verizon, vendors you pay regularly, you don't question it the same way you'd question a new vendor. That familiarity creates vulnerability. Real talk. Most finance departments could be robbed using forged letterhead from their top 10 vendors, and detection would take months. At a financial services company I worked for, we discovered someone had been changing vendor payment addresses for years, collecting approximately $400,000 across dozens of small diversions before an external auditor noticed the same P.O. box appearing for multiple unrelated vendors. Personal purchase schemes involve employees using company funds to buy goods or services for their personal use while disguising the purchases as legitimate business expenses. The company pays, the employee receives the benefit, and the fraud hides inside procurement processes designed for efficiency rather than verification. This is budget arbitrage, spending someone else's money on your priorities. Every time you've added something to your cart and thought, wait, is this a want or a need? That's budget discipline. You're financially accountable because it's your money, but give someone else's money to spend. That discipline erodes rapidly. Companies experience this when employees order office supplies that include personal laptops, submit Amazon business orders mixing legitimate equipment with PlayStation consoles, book client entertainment at steakhouses that are actually family dinners, or purchase facility maintenance tools that end up in personal garages. The amounts are usually strategically small, under $500 per transaction, specifically to avoid scrutiny thresholds. Nobody's investigating the $287 office supply order. But do that twice monthly for 3 years, and you've stolen $20,000. Small theft repeated becomes major fraud. It's like compound interest, except you're the bank, and the company is the depositor who doesn't know they're making contributions. Detection requires matching purchases to actual organizational needs. If an employee orders 10 ergonomic chairs, but their department has 6 people, someone should ask questions. If maintenance orders commercial-grade tools, but your facility uses contracted maintenance services, that's suspicious. If marketing orders video editing software, but no one in marketing does video work, investigate. Major retailers and home improvement chains deal with employee purchase schemes constantly. At a nonprofit where I consulted, we discovered an employee had been ordering cleaning supplies for their personal house cleaning side business using our vendor accounts. Over 4 years, approximately $35,000 in supplies never showed up at our facilities. They got caught only because they got greedy and ordered a pressure washer requiring signature confirmation. The delivery person couldn't find anyone who'd ordered it. Investigation revealed years of small purchases, none individually suspicious, collectively devastating. This is why mastering fraud detection makes you indispensable. You see patterns others miss. The fraudster defeated threshold controls by keeping individual amounts low, but they couldn't defeat trend analysis showing one employee's ordering patterns dramatically exceeded everyone else's. Check tampering involves fraudulent physical manipulation of company checks to steal funds. Unlike billing schemes where fraud happens in documentation before payment, check tampering happens to the payment instrument itself. Someone literally changes or creates the check that moves money out of company accounts. This requires physical access to checks and understanding of check processing systems, sufficient to avoid immediate detection. Think about this disconnect. You probably haven't written a physical check in years. Venmo, Cash App, Zelle, Apple Pay. You move money digitally with authentication, requiring biometrics or passwords. Yet businesses still write millions of checks annually because many vendors prefer them, government payments require them, and some industries haven't fully transitioned to ACH. Every physical check is a vulnerability because it's a bearer instrument. Whoever presents it can potentially cash it if it appears legitimate. Here's what's absurd. We've built sophisticated digital security for our personal $47 transactions, while companies move $47,000 using paper documents that can be altered with household chemicals available on Amazon. Your bank requires two-factor authentication to move $100 online, but some companies mail checks for $100,000 with one signature through regular USPS, trusting postal service and recipient honesty. The security differential is completely backwards. Physical checks are more vulnerable than digital payments, but organizations protect digital transactions more carefully because digital feels riskier. The Secret Service estimates check fraud costs businesses $815 million annually in the U.S. alone. Most of that comes from insiders who understand check processing well enough to exploit weaknesses. When I worked at a government procurement office, we discovered someone had been creating duplicate checks using stolen check stock and forged signatures. They'd write a legitimate check to a vendor for $50,000, then create an identical check with their account information. Both checks hit the system before monthly reconciliation caught the duplicate. By then, they'd cashed out. The fraud succeeded because physical controls on blank check stock were terrible. Locked drawer with keys secured in multiple desks. Forged maker schemes involve someone creating or signing a check without proper authority, forging the signature of an authorized signer to make the payment appear legitimate. The fraudster needs access to blank check stock and knowledge of whose signature to forge. But once they have both, they're essentially printing money with the company's account backing. You've probably practiced someone's signature at some point, maybe signing a parent's name on a permission slip, maybe just doodling. Most signatures aren't complex. 3 seconds of practice and most people can produce something close enough that a bank teller glancing at hundreds of checks daily won't catch it. That's terrifying when you realize signature verification is often the only control. A study found bank tellers correctly identified forged signatures only 58% of the time, barely better than coin flip accuracy. They're processing 200 plus checks per shift, spending maybe 3 to 5 seconds per check, looking for obvious problems, not forensic quality analysis. This means if your forgery is decent and your check properly formatted, you're probably getting paid. The fraudster isn't defeating sophisticated security, they're defeating rushed human observation. At a major financial institution I worked for, we investigated a case where an administrative assistant had been forging the CFO's signature on checks for 8 months. She had access to the CFO's signature on hundreds of documents, practiced until her forgery was nearly perfect, and knew the check sequencing system well enough to avoid gaps triggering scrutiny. She wrote checks to herself for amounts between $3,000 to $8,000, spacing them across months to avoid pattern detection. Total theft, $137,000. She got caught only because she got greedy and wrote a $15,000 check requiring secondary approval she couldn't forge. Had she maintained her established pattern, she might still be stealing today. Prevention requires restricting access to blank check stock, locked in secure locations with access logs tracking who removed checks and when, dual signatures for disbursements above specified thresholds, automated check signing machines that don't require physical signature stamps. But many companies keep blank checks in unlocked drawers, leave signature stamps in desks, and trust that employees won't abuse access. That trust is the vulnerability. Forged endorsement schemes involve intercepting checks intended for legitimate payees, forging the payee's endorsement, and depositing them into accounts controlled by the fraudster. This requires ability to intercept checks, usually through mailroom access, accounts payable position, or mail theft, plus capability to endorse and deposit checks not intended for you without triggering bank scrutiny. When you order something online and it says delivered, but you never received it, you know someone took your package. That's physical interception. Forged endorsement schemes are the financial equivalent. Someone intercepts the check meant for vendor A, forges vendor A's endorsement, and cashes it. Vendor A never receives payment and eventually complains. The company says, "We paid you, here's the canceled check." Vendor A says, "That's not our endorsement." Investigation reveals theft. The bold assumption fraudsters make is that nobody will compare endorsements, and often they're right. When's the last time your bank called to verify an endorsement on a deposited check was actually yours? Never. Banks process billions of checks and aren't handwriting analysis experts. They assume endorsements are legitimate unless someone specifically disputes them. Mobile deposit has made this worse. You can endorse a check with a scribble, photograph it, and deposit through an app without any human examining it. Technology increased convenience while decreasing verification. Real example. At a nonprofit where I consulted, the mailroom clerk was intercepting checks sent to the organization, forging the organization's endorsement, and mobile depositing them into their personal account. Over 2 years, approximately $290,000 stolen. The nonprofit didn't notice because they assumed checks that never arrived were simply donors who changed their minds or pledges that didn't materialize. Only when a major donor called saying, "Why haven't you cashed my $25,000 check?" did investigation begin. The donor had proof of mailing via certified mail receipt. The nonprofit had no record of receiving it. The check had been deposited, just not into the nonprofit's account. That theft continued for 24 months because nobody connected missing deposits to the one person who handled all incoming mail. Prevention requires separating mail handling from deposit processing, performing vendor confirmations periodically, asking vendors to verify payments received match payments sent, and implementing positive pay systems where banks verify endorsements match authorized signers. Altered payee schemes involve changing the designated payee on a check that's already been prepared, redirecting payment to the fraudster or an account they control. This happens through physical alteration, using chemicals to erase ink or whiteout to cover names, or through digital manipulation if the employee has access to check printing systems before checks are signed. Remember correction fluid? Whiteout? Seems ancient technology, but companies still use physical checks, which means physical alteration remains possible. You can buy check washing chemicals online, solutions that remove certain inks while leaving others intact. Fraudsters use these to erase payee names, amounts, or both, then rewrite checks to themselves. It's like having an undo button for reality. The check was written to Verizon for $5,000. The fraudster chemically removes Verizon and writes their own name. The signature remains valid because it wasn't touched. The bank sees a properly signed check and processes it. What's interesting is this fraud is simultaneously low-tech and effective. In an era of blockchain, AI, and quantum encryption, someone with a $12 bottle of chemicals and steady hands can rob a company. The sophistication isn't in the method, it's in selecting which checks to alter and timing to avoid detection. Smart fraudsters alter checks during month-end close, when AP is overwhelmed and less likely to notice irregularities. They target checks to vendors who invoice frequently, knowing one altered check among dozens is harder to spot. They alter smaller amounts falling below review thresholds. Detection usually happens when the legitimate payee complains they haven't been paid, triggering an investigation revealing the alteration. But by then, the fraudster has cashed the check and often committed the fraud multiple times. Prevention requires positive pay systems, where banks only honor checks matching pre-submitted lists of payees and amounts. Any deviation triggers bank notification requiring authorization before payment. But many organizations don't implement positive pay because it costs money up front and requires process changes. So they stay vulnerable, saving $10,000 annually in positive pay fees while losing $100,000 to altered check fraud. Concealed check schemes involve submitting fraudulent checks hidden within batches of legitimate checks, relying on volume and routine to avoid detection. The fraudster prepares a stack of proper checks for legitimate business purposes, then inserts one or more fraudulent checks into that stack, hoping supervisors signing multiple checks won't scrutinize every single one carefully. This exploits human fatigue and trust in process. Picture this. You're a CFO at month end, and your AP manager brings you 50 checks to sign for vendor payments. You've been in meetings all day, it's 4:45 p.m., and you want to go home. Do you read every single check carefully, verifying every payee and amount against supporting documentation? Or do you flip through, spot checking a few, and sign them all assuming your AP team did their job properly. Most choose the latter. That's human nature meeting operational reality. Fraudsters exploit that fatigue. The concealed check looks exactly like legitimate checks in the stack. Same check stock, same format, same signature line. Only the payee and possibly the amount are fraudulent. It might be made out to the fraudster personally, to their shell company, or to a legitimate sounding but fake vendor. Because it's physically mixed with legitimate checks, the fraudster is betting on probability. If only 10% of checks get scrutinized carefully, they have 90% chance of success per attempt. Prevention requires mandatory review of check sequences to identify missing numbers. If checks 5001 to 5050 were printed, but only checks 5001 to 5048 appear in the approval stack, where are checks 5049 and 5050? Fraudsters might remove fraudulent checks from the stack temporarily, get legitimate checks signed, then add fraudulent checks back to the signed stack before submitting for processing. Sequence gaps reveal this manipulation. Also requires counting physical checks in submission batches against documented counts. If the system shows 50 checks were prepared, but 52 checks appear for signature, investigation is warranted. At a company I consulted with, we discovered an AP clerk had been inserting one fraudulent check per week into legitimate check runs for 11 months. Total theft, $63,000. The amounts were always under $1,500, making them individually unremarkable. The CFO signed 200 to 300 checks monthly and admitted to not reading every single one carefully. The fraud was detected only when we implemented automated sequence checking software that immediately flagged gaps. Human review had failed for nearly a year. Automation caught it in the first weekly run. Authorized maker schemes. Authorized maker schemes involve individuals who legitimately have authority to sign checks, using that authority to write fraudulent checks to themselves or accomplices. This is the ultimate abuse of trust. The person empowered to disperse company funds, exploiting that power for personal gain. No forgery required, no physical manipulation needed. The signature is genuine. The purpose is fraudulent. Think about this. You give your friend your debit card PIN because you trust them to withdraw $50 for you while you're busy. They withdraw $50 for you and $200 for themselves. The bank approved the transaction because the PIN was correct. Your friend had legitimate access. They just abused it. That's authorized maker fraud. Legitimate access used illegitimately. This is particularly dangerous because many detective controls fail. Signature verification passes, it's their actual signature. System access controls passes, they're authorized users. Approval workflows bypassed, they are the approval. The fraud succeeds despite controls functioning properly because the fraudster occupies a trusted position. Organizations defend against external threats while the threat is internal and credentialed. Common scenarios. A small business owner with sole check signing authority writes checks to personal creditors and records them as business expenses. A nonprofit executive director writes checks to family members for services never rendered. A corporate treasurer writes checks to their own consulting business for advisory services they never provided. The checks are technically legitimate, properly signed, properly formatted, but the underlying purpose is theft. Detection requires separating check preparation from check signing, implementing dual signature requirements for amounts above thresholds, typically $5,000 to $10,000, requiring supporting documentation for all disbursements, regardless of signer authority, and most importantly, regular independent review of all disbursements by board members, audit committees, or external auditors. But here's reality. Small organizations often can't afford separation of duties, and even large organizations grant exceptions for senior executives, creating vulnerability. At a nonprofit where I conducted forensic investigation, the executive director had sole check signing authority and wrote checks to themselves totaling $180,000 over 3 years for consulting fees and expense reimbursements. The board trusted them completely and never reviewed disbursements. Only when a whistleblower reported suspicions did investigation reveal the fraud. The checks were perfectly legitimate in form, properly signed, properly processed. The purpose was completely fraudulent. Fraudsters don't just tamper with checks, they conceal the tampering through sophisticated techniques designed to make fraudulent checks appear legitimate during reconciliation and audit. Understanding concealment methods is crucial because detection often focuses on finding the cover-up rather than finding the initial fraud. Reconciling fraudulent checks involves the fraudster ensuring that stolen checks appear legitimate in bank reconciliations. They might alter check registers to match fraudulent check amounts and payees, making the books balance even though actual checks were fraudulent. Or they mark fraudulent checks as outstanding month after month, delaying when the fraud surfaces in reconciliation. Or they alter cleared check images in the reconciliation process to show legitimate payees instead of actual fraudulent payees. Altering disbursement journals means changing accounting records to hide fraudulent payments. A check written to the fraudster gets recorded in accounting as payment to a legitimate vendor. The general ledger shows proper payments. Only the actual check reveals fraud. This works when the person performing reconciliation trusts accounting records without verifying against physical checks. It's the difference between what books say and what banks say. Fraudsters manipulate books to match banks so nobody questions discrepancies. Using bogus documents or reissued checks involves creating fake supporting documentation, justifying fraudulent checks. Fraudster writes themselves a check, then creates a fake invoice explaining the payment. Or they write a fraudulent check, then later write a legitimate check for the same amount to the same vendor, recording both as payment for a single invoice. The legitimate check satisfies the vendor. The fraudulent check enriched the fraudster. Books show only one payment because that's all that was invoiced. You already understand concealment instinctively. When you do something you shouldn't, and then cover your tracks, deleting browser history, hiding evidence, creating alibis, that's concealment. Pause. The illegal activity itself might be spontaneous, but the cover-up is usually methodical. Same principle applies to financial fraud. The initial theft might be opportunistic, but concealment is calculated and ongoing. Fraudsters spend more energy hiding theft than committing it. Detection requires comparing multiple data sources, bank statements, canceled checks, accounting records, and supporting documentation. When these sources conflict, investigation reveals fraud. At a manufacturing company I consulted with, we discovered someone had been altering monthly reconciliation spreadsheets to hide fraudulent checks. The bank statement showed checks to individuals. The reconciliation spreadsheet showed checks to vendors. Nobody caught it for 14 months because the responsible person controlled both check signing and reconciliation. Complete segregation of duties failure. Only when we implemented independent reconciliation performed by someone without check access did the fraud surface. Prevention and detection require layered controls addressing both opportunity and concealment. The foundation is segregation of duties, ensuring no single person can prepare, sign, and reconcile checks. One person prepares payment documentation, another person signs checks, a third person performs bank reconciliation. Nobody can complete fraud alone because nobody has complete access to the entire process. But here's what actually happens. Small companies can't afford 4 separate people handling checks, so roles get combined. Medium-sized companies have the people but weak physical controls. Blank checks in unlocked drawers, signature stamps left unattended. Large companies have great physical controls, but automated so many processes that segregation exists on paper, but not in practice. One person can override systems if they have sufficient access rights. Pause. The theory of internal controls is beautiful. The implementation is where companies get robbed. Restrict access to blank checks. Physical check stock should be locked in secure locations, with access logs tracking who removed checks and when. Pre-numbered checks allow sequence tracking. Periodic physical counts verify all checks accounted for, but this requires discipline and monitoring. Most organizations don't maintain. Dual signatures for large disbursements means checks above specified thresholds, commonly $5,000 to $10,000, require two authorized signatures. This prevents any single authorized signer from committing large fraud independently. Review sequence gaps by examining check numbers to identify missing checks. If checks 1001 to 1500 were issued, but check 1027 never cleared, investigate. Might be outstanding, might be lost, might be fraudulent. Vendor confirmations involve periodically contacting vendors, asking them to verify payments received, match your records of payments sent. Discrepancies indicate potential fraud. Either checks were intercepted, altered, or never sent despite being recorded. Big data analytics transforms detection from sampling to population analysis. Extract all voided checks and reconciling items to identify patterns. Same user voiding multiple checks, voids and reissues on same day, voids for amounts matching subsequent cash withdrawals, all warrant investigation. Identify users with both check writing and general ledger posting access, which violates segregation of duties. If someone can both disperse funds and record transactions, they can commit and conceal fraud independently. Analyze manual checks separately from system-generated ones, because manual checks bypass normal controls. Why was this check written manually, instead of through the system? What emergency justified circumventing procedures? Flag checks payable to cash because those are extremely high risk. Legitimate business rarely requires checks to cash. At a Fortune 500 company I consulted with, I ran analytics showing 23 manual checks totaling $187,000 had been written to cash over 6 months. Every single one violated policy. Investigation revealed an elaborate check kiting scheme. The data pointed to fraud before anyone confessed. That's the power you're developing, using analytics to make visible what fraudsters try to hide. Payroll schemes involve false claims for compensation, manipulating payroll systems to receive payment for work not performed, or payment amounts exceeding legitimate entitlement. These schemes exploit the automated nature of payroll processing. Once someone's in the system, payments generate automatically until someone specifically stops them. The fraud rides on organizational momentum. Think about subscription services. You sign up for a free trial, forget to cancel, and suddenly you're paying monthly for something you don't use. The system assumes continuity. Cancellation requires active intervention. Payroll works identically. Once employees are enrolled, paychecks generate automatically. Nobody verifies every pay period that employees still work there, still work the hours claimed, or still warrant the compensation received. The system trusts its own data. Fraudsters exploit that automated trust. Payroll fraud is particularly insidious because it's continuous. Billing scheme fraud requires repeated actions, submitting new fake invoices each time. Payroll fraud is passive income. Establish the fraud once, collect every pay period until detected. A ghost employee making $50,000 annually generates $1,923 per biweekly paycheck. That's not a single theft. It's 26 thefts annually, compounding until detection. The longer it runs undetected, the larger the loss. Median payroll fraud losses exceed $62,000 per case, and schemes run an average of 30 months before detection. That's 2.5 years of continuous theft, hidden inside normal payroll operations. Ghost employee schemes involve placing fictitious employees on payroll and collecting their paychecks. The fraudster creates fake personnel records, complete with social security numbers, addresses, and bank accounts, then ensures those employees get paid regularly despite never actually working for the organization. This requires access to HR or payroll systems or collaboration with someone who does. Think about group projects where someone's name appears on the submission, but they contributed nothing. They get the grade, they get the credit, but they didn't do the work. Ghost employees are the financial version. Names on payroll, getting paid for work. They're definitely not doing because they don't exist. At least in your group project, that person was real. In ghost employee schemes, you're literally inventing human beings and paying them company money. The boldness is remarkable. Someone creates a fake identity, fake name, fake social security number, fake address. adds this person to HR systems, enrolls them in payroll, and starts collecting paychecks. Sometimes it's the fraudster's own bank account, receiving direct deposits. Sometimes it's checks mailed to an address they control. Sometimes it's a legitimate person's stolen identity being used without their knowledge. The fraudster processes terminations and new hires for the ghost periodically to avoid suspicion from static records, creating employment history that looks realistic. This happens more than you'd think. The Department of Defense discovered 70,000 plus potential ghost employees, costing taxpayers $1.2 billion. Major corporations have uncovered ghost employee schemes and subsidiaries. At a nonprofit where I worked, we found a payroll manager had created 3 ghost employees over 5 years, collecting approximately $380,000 in fraudulent wages. The ghost had perfect attendance, never sick, never late, never complained. That perfect employee profile is actually a red flag. Real employees have variability. Ghosts are suspiciously consistent because they're not subject to human messiness. Falsified hours and salary schemes involve employees inflating hours worked or receiving unauthorized salary increases to collect more compensation than legitimately entitled to earn. This requires either falsifying timekeeping records, adding hours to timesheets, having coworkers clock in for absent employees, buddy punching, or claiming overtime never worked, or manipulating salary databases to grant themselves or accomplices unauthorized raises without proper approval. Every hourly worker understands timesheet temptation. You worked 7.8 hours, but the timesheet has room for 8.0, so you write 8.0. That extra 12 minutes, multiplied across hundreds of employees, costs thousands monthly. Most companies accept minor timesheet inflation as inevitable, impossible to verify every minute. But some employees push this way beyond minutes. They claim double shifts they didn't work. They have coworkers clock them in while they're actually home. They submit timesheets showing 60 hours weekly when they worked 35. Small inflation becomes major fraud. Here's what's wild. Managers often ignore obvious timesheet fraud because confronting it requires documentation, investigation, and potential termination, all of which takes time and creates hassle. Pause. So they just don't. An employee claims 55 hours, the manager knows it's exaggerated, but approving it is easier than fighting it. That manager just became an accomplice through willful ignorance. The employee learns the system tolerates fraud, so they escalate. What started as adding 30 minutes becomes adding entire days. Salary manipulation is sneakier. Someone with HR system access grants themselves a 15% raise without approval, knowing most people don't scrutinize every name on massive payroll reports. Or they add bonuses coded as regular pay to avoid bonus approval processes. Or they reclassify themselves as overtime eligible when they're actually salaried exempt, then submit false overtime claims. At a major financial services company where I worked, we caught an HR generalist who had given herself 7 unauthorized raises over 3 years, increasing her salary from $52,000 to $89,000. Nobody noticed because organizational payroll spending was $400 million annually. Her increases were invisible in aggregate reports. Only when we ran analytics comparing individual salary progression to performance review data and approved raise documentation did the anomaly appear. Prevention requires supervisor approval for time and pay changes, no timesheet adjustment or salary modification without documented supervisor authorization. Trend and exception analysis for overtime and bonuses identifies employees whose overtime or bonus compensation significantly exceeds peer averages or historical patterns. Regular pay increases for no documented reason. Red flag. Sudden overtime spike with no corresponding business justification. Investigate. Commission schemes involve salespeople inflating or fabricating sales figures to increase their commission-based compensation. Methods include overstating sales quantities or prices, booking personal purchases through commercial accounts to generate commissions, creating fake sales that get reversed after commission is paid, or timing sale recognition to maximize commissions. even when recognition violates revenue recognition policies. If you've ever worked retail or sales, you know the pressure. Hit targets or hit unemployment. That pressure creates rationalization. I'm not stealing, I'm just ensuring I get paid what I deserve. That's the voice of someone about to commit commission fraud. The fraud triangle is operating perfectly. Financial pressure from quotas, opportunity through sales system access, and rationalization through moral flexibility about what constitutes fair compensation. Salespeople at car dealerships, electronics retailers, pharmaceutical companies, and B2B operations have all been caught inflating sales to boost commissions. Common method: convince a customer to buy today with promise they can return next month for full refund. Book the sale to earn commission, then process the return after commissions are paid. The company loses the sale, but the salesperson keeps the commission. Or consider this: sales rep creates fake customers in the system, books sales to those customers, earns commission, then writes off the unpaid invoices as bad debt. The company thinks they had legitimate sales that didn't collect. The sales rep walks away with fraudulent commissions. The absurdity: companies spend millions on CRM systems tracking every customer interaction, but often have weak controls over commission calculations. They know every time a customer clicks a web page but can't verify whether their own salespeople are gaming commission structures. At a major automotive manufacturer I worked for, we investigated sales manipulation where reps split large fleet sales into multiple smaller individual sales to maximize per unit commission bonuses. The customer bought 50 vehicles as one transaction. The system recorded it as 50 individual sales because each vehicle technically got its own invoice. Total commission difference: $75,000 annually across the team. Perfectly legal according to system rules. Completely fraudulent according to compensation policy intent. That's where forensic accounting meets ethics. Detection requires monitoring gross pay, overtime ratios, and commission to sales correlations. If a salesperson's commission to sales ratio significantly exceeds peers, investigate. If commissions increase but actual sales volume decreases, something's wrong. If the same salesperson processes unusually high returns or credits after sales, they might be booking fake sales for commissions, then reversing them. Analytics reveal these patterns when comparing individual performance to cohort averages over time. Prevention requires separating hiring authority from payroll processing. HR adds employees after verifying employment documentation, but payroll independently verifies new hires before processing payments. This prevents HR from adding ghost employees without payroll knowledge. Supervisor approval for all timesheets and pay changes with audit trails. Documenting approvals ensures accountability. No timesheet processes without supervisor signature. No salary adjustment without documented authorization. Regular trend analysis comparing payroll costs to headcount, revenue, and historical patterns identifies anomalies. If headcount increases 5%, but payroll costs increase 15%, investigate. If individual departments show payroll growth inconsistent with business growth, dig deeper. If certain employees consistently earn significantly more than peers in similar roles, understand why. Personnel files are periodically audited to verify employees actually exist, and work where records indicate physically verify that employees showing up in payroll also show up in offices. Data analytic techniques transform payroll fraud detection. Compare payroll databases to HR databases looking for mismatches, employees paid but not hired, termination dates in HR but continued payments in payroll. Identify duplicate SSNs. Legitimate employees have unique social security numbers. Ghosts might reuse numbers or use invalid sequences. Flag duplicate direct deposits. Multiple employees with identical bank account information suggest one person collecting multiple paychecks. Identify round dollar payments because legitimate payroll includes taxes and deductions, creating irregular amounts like $1,847.23. Round numbers like $2,000 suggest manual manipulation. Monitor gross pay, overtime ratios, and commission to sales correlations. Employees whose gross pay significantly exceeds expectations based on hours and rate, investigate. Overtime constituting 40% plus of total pay when peers average 10%, red flag. Commissions not correlating to documented sales, fraud possibility. Best prevention story. Company implemented biometric time clocks requiring fingerprint scans to eliminate buddy punching. Instantly eliminated one fraud vector. But 6 months later, payroll costs hadn't decreased as expected. Investigation revealed employees were using moldable silicone to create fake fingerprints of coworkers. Pause. Humans are relentlessly creative at defeating controls. Every control is temporary until someone figures out the workaround. That's why forensic accountants stay employed. We're in an eternal arms race with fraudsters, and both sides keep innovating. You're joining that arms race on the side defending organizational resources. Expense reimbursement schemes involve employees submitting false or inflated expense reports to receive payment for costs they didn't actually incur, or that weren't legitimate business expenses. These schemes exploit the trust-based nature of expense reimbursement. Organizations assume employees are honest about their expenses and often don't verify receipts thoroughly because verification costs exceed occasional small frauds. You've experienced the reimbursement honor system. You pay for something on behalf of a group, then everyone Venmos you their share. You're trusting them to pay the right amount, and they're trusting you to request the right amount. Most people are honest because amounts are small and relationships matter, but scale this to corporate expense accounts, where you're requesting reimbursement from an impersonal entity, not your friends, and suddenly the social pressure for honesty disappears. The company isn't going to be disappointed in you. Finance isn't going to give you guilt trips. They're just processing reports according to policy. Here's the psychological shift enabling expense fraud. Personal money feels real. Company money feels fictional. When you're spending your own money, every dollar matters. You comparison shop, hunt for discounts, skip unnecessary purchases. When you're spending company money that will be reimbursed, suddenly you're ordering appetizers, desserts, premium drinks, and upgraded hotel rooms. It's business development, you tell yourself. That's not fraud yet, that's rationalization. Fraud happens when you start submitting receipts for expenses that weren't business related at all, or inflating costs, or reusing receipts, or submitting complete fabrications. Companies lose an estimated 5% of revenue to fraud annually, and expense reimbursement schemes account for a significant portion. Industries with high travel requirements, consulting, sales, field services, show higher rates because opportunity is greater. At a nonprofit where I worked, expense fraud was rampant because the culture was, we're all underpaid. Padding expenses is how we make up for low salaries. That rationalization normalized theft. Management knew it happened, employees knew it happened, but confronting it meant admitting systemic pay problems. So fraud continued until a new CFO audited 3 years of expense reports and found $150,000 plus in fraudulent claims. Mischaracterized expense schemes involve claiming personal expenses as business expenses to obtain reimbursement. The expense actually occurred and the receipt is real, but the purpose was personal, not business. Classic examples: family vacation disguised as client visit, personal meals claimed as business meetings, gym memberships framed as wellness program costs, home office equipment that's actually for personal use, or spouse travel costs claimed as administrative assistance. When you're looking at your budget, trying to decide if something is essential or optional, you're doing categorization. Is this protein powder for fitness or just a want? That same categorization judgment applies to expense reports, except the employee is incentivized to miscategorize everything as business because someone else pays. Your Friday night date becomes client entertainment dinner. Your spouse's ticket on your business trip becomes administrative support travel. Your Audible subscription becomes professional development. One person's fraud is another person's aggressive but defensible categorization. Major tech companies and consulting firms have sophisticated expense policies trying to define every gray area, yet mischaracterization persists because enforcement is selective and audit rates are low. Most companies audit maybe 5% of expense reports, and those audits focus on high amounts, not frequent small claims. So employees submit $47 restaurant receipts, knowing probability of scrutiny is near zero. We'll spend $100 in audit time to verify a $47 expense. Math doesn't math, so fraud continues unchallenged. Real example. At a financial services company I worked for, an executive submitted monthly client entertainment expenses at premium steakhouses totaling $3,000 to $5,000. For 2 years, approved without question. Executives have clients. Entertainment happens. Only when an analyst noticed the same restaurant every single month, always on Friday nights, always for roughly same amount, did investigation begin. Turned out, no clients, just family dinners. Total fraud, $97,000. The executive was senior enough that nobody questioned expenses until data analytics flagged the pattern. Seniority creates opportunity because people assume senior employees understand policies and would never violate them. That assumption costs companies millions annually. Overstated expense schemes involve submitting legitimate receipts, but inflating the amounts to collect more than actually spent. Methods include altering receipts with software to increase totals, claiming higher mileage than actually driven, inflating per diem claims when policies allow estimates rather than requiring receipts, or adding personal expenses to legitimate business expenses, and submitting the combined total as entirely business-related. You've seen how easy it is to edit images on your phone, crop, filter, adjust brightness. Receipt editing software uses similar principles to modify PDFs or photos of receipts, changing $45 to $145, altering dates, or even creating entirely new receipts using templates available online. Quality varies. Some are obviously fake, others require forensic analysis to detect. But most companies don't forensically analyze receipts. They glance, verify they exist, and approve reimbursement. Here's the economic logic fraudsters use. If you inflate a $50 receipt to $75, you've gained $25 for essentially zero risk. Most companies won't catch it. If they do catch it, you claim it was an error. Oh, I must have grabbed the wrong receipt. Or, sorry, that was a typo. Worst case, you repay the $25. Best case, you profit. Low risk, positive expected value. Economically rational fraud. That's what makes expense fraud so persistent. The incentive structure encourages dishonesty because consequences are minimal and detection is rare. Mileage fraud is particularly common. Employees claim 500 miles when they drove 300, or claim personal trips as business travel. Companies typically reimburse 67 cents per mile, current IRS rate, so inflating 200 miles generates $134 in fraudulent reimbursement per trip. Multiply across 50 trips annually, and that's $6,700 stolen. Since most companies don't verify mileage with GPS data, toll records, or Google Maps calculations, the fraud is essentially undetectable unless someone specifically investigates. At a government procurement office where I worked, we caught someone claiming per diem for business travel that never happened. They'd request travel approval, get authorized, then claim to have traveled and submit per diem claims without actually going anywhere. Over 18 months, $23,000 in per diem fraud for trips they never took. Got caught only because someone noticed they were traveling during weeks they were clearly in the office attending meetings. The data showed badge access records contradicting travel claims. That's why integrating data from multiple systems is powerful. The fraud can't maintain consistency across all systems simultaneously. Fictitious expense schemes involve creating completely fake receipts or claiming expenses that never occurred. This includes generating receipts using online receipt generators, submitting photocopied receipts from internet images, fabricating expenses with no supporting documentation when policies allow, or claiming expenses during periods when no business activity occurred, like claiming business meals during vacation. Creating fake receipts is easier than you'd think. Dozens of websites offer receipt generators where you input merchant name, amount, date, and items. then download a PDF that looks completely legitimate. Some even include merchant logos and proper formatting. You can generate a receipt from any restaurant, hotel, or store without ever having been there. The internet has democratized fraud. Now, anyone with basic computer skills can fabricate documentation that used to require sophisticated forgery skills. The absurdity is how many employees attempt this, despite obvious red flags. Submitting an Olive Garden receipt for dinner in Des Moines while your calendar shows you in a company meeting in Dallas. That's going to get caught. Claiming $300 in taxi fares in a city where average taxi rides cost $15. Someone's going to question that. Submitting hotel receipts for dates when you were on vacation according to HR records. Investigation will follow. Yet employees attempt these schemes regularly because they assume nobody actually verifies. Reject photocopied documentation as policy. Require original receipts or digital receipts with verifiable metadata. Photocopies can hide alterations and prevent verification. Review claims during vacation periods specifically because business expenses during personal time are inherently suspicious. If an employee submits expense report for business dinner on dates they were on approved vacation, investigate. Detection requires comparing expense report data to multiple sources. Corporate card statements, any expenses claimed that weren't on the card, calendar appointments, do claimed meals align with scheduled meetings, travel records, do claimed travel expenses match authorized trips, and employee leave schedules, business expenses during vacation. At a manufacturing company I consulted with, analytics revealed an employee had submitted restaurant receipts for client meetings on 14 different dates when they were on approved leave. Total fraud, $4,200. Small individually, significant aggregate, and completely avoidable with basic cross-system verification. Multiple reimbursement schemes involve submitting the same expense multiple times to receive duplicate payment. Methods include submitting the same receipt to the same employer repeatedly, hoping nobody remembers approving it previously. Submitting expenses to multiple employers for the same cost, when working for multiple companies simultaneously, or paying with corporate card, but also submitting expense report for reimbursement, getting paid twice for same expense. The logic is brazen. Most expense management systems have duplicate detection software, but employees defeat it by slightly altering submission dates, categorizing expenses differently, or using different file names for receipt images. The system looks for exact duplicates. Fraudsters ensure nothing is exactly identical. 1 week they submit client dinner ABC Corp. For $187.42 on March 15th. 3 months later, they submit business meeting meal for $187.42 on 3/15 with a slightly different scan of the same receipt. Different report, different category, different description. System doesn't flag it as duplicate. Here's what's wild. Some employees submit the same hotel receipt to their employer and to their client for reimbursement, collecting twice. Or they pay for conference registration with corporate card, then also submit expense report for the registration fee, essentially getting the company to pay twice. Or they book travel, get reimbursed, then cancel the travel and keep the refund. Each instance seems minor, $200 here, $500 there, but annual totals can reach tens of thousands. We're smarter than the software, until the software learns our tricks. Then we learn new tricks. It's an evolutionary arms race between control systems and human creativity. This is why forensic accountants stay employed. We're updating detection methods faster than fraudsters update evasion methods. Detection requires comparing expense report data to corporate card statements. Any gap represents potential fraud. Expenses appearing in reports but not on card statements, either paid personally, legitimate, or never actually incurred, fraud. Expenses appearing on card statements but also in expense reports, duplicate reimbursement. Sequence duplicate receipt analysis by digitally comparing submitted receipts across time periods looking for identical images resubmitted months apart. At a manufacturing company I consulted with, analytics revealed an employee had submitted the same hotel receipt for reimbursement 7 times over 2 years, each time slightly altering the date on the image. Total theft, $1,800. small potatoes individually, but they had been doing this across dozens of receipts. Aggregate fraud, over $40,000. The fraud was invisible to human reviewers, but obvious to image comparison software that matched pixel patterns across submissions. Prevention requires policy enforcement combined with analytical detection. Require original receipts and timely submission. Expense reports must be submitted within 30 to 60 days of expense occurring with original receipts attached. Stale-dated submissions are suspicious because they're harder to verify and suggest the employee needed time to fabricate documentation. Flag duplicate or rounded amounts. Multiple expenses for exactly $50 or $100 suggest estimates or fabrications rather than actual documented costs. Data analytic applications transform detection from sampling to population analysis. Compare expense timing to employee leave, business expenses occurring during approved vacation or sick leave warrant investigation. Cross-reference expense reports with HR. Leave records automatically. Identify unusual merchant codes, SIC codes. If an employee traveling to Dallas for business submits receipts from merchants in Miami, according to SIC codes embedded in receipt data, they're either submitting old receipts or fraudulent receipts. Require timely submission because delays enable fraud. The longer between expense and submission, the harder verification becomes. Memories fade, supporting documentation gets lost, witnesses become unavailable. Require submission within 30 days of expense occurring. Exceptions require management approval with documented justification. Another powerful technique, random audit sampling weighted toward high-risk indicators, frequent travelers, high expense amounts, unusual patterns. Announce that random audits occur, but don't announce who's being audited or when. The uncertainty creates deterrence. If employees know 10% of expense reports get thoroughly audited, but don't know which 10%, rational employees avoid fraud because the detection risk isn't worth the gain. Real-world implementation. Consulting firm implemented expense analytics software that flagged 400 plus suspicious expense reports monthly out of 10,000 plus total submissions. Manual review of those 400 identified approximately 50 instances of confirmed fraud monthly, recovering $30,000 to $50,000 monthly in fraudulent claims. The software paid for itself in the first month just from fraud detected. That's the power of analytics, turning what used to require armies of auditors into automated pattern recognition that humans investigate only when probability of fraud is high. Registered disbursement schemes involve fraudulent entries at point-of-sale systems, false refunds or false voids, used to conceal theft from cash registers. These schemes exploit the transactional nature of retail operations where hundreds of small transactions daily make individual transaction verification impractical. The fraud hides inside the volume and velocity of legitimate retail activity. If you've ever returned something at a store, you experience the process. Bring item, show receipt. They process refund. You get money back. The POS system logs the transaction. Inventory theoretically increases. Revenue reverses. But what if the employee processes that refund without anyone actually returning anything? The system still logs it. Inventory appears to increase. Revenue appears to reverse. But there's no customer, no returned merchandise, just the employee taking cash from the register equal to the refund amount. This works because point-of-sale systems assume transactions are legitimate unless proven otherwise. When a refund gets processed, the system doesn't verify that a customer is standing there or that merchandise was actually returned. It just executes the transaction. Cash register short at end of shift? The refunds explain it. Inventory counts don't match receipts? Refunds explain that too. The fraud hides inside explanations that seem reasonable until someone actually investigates whether those refunds were legitimate. Major retailers and local boutiques deal with these schemes constantly. The transactional volume creates opportunity. When your store processes 2,000 transactions daily, who's verifying that transaction 1,247 was legitimate? The assumption is that customers and employees are honest, systems function properly, and exceptions are rare. Fraudsters exploit that assumption systematically. False refund schemes occur when employees process fraudulent refund transactions and pocket the cash. The system shows a refund was issued to a customer, but no customer actually returned merchandise. The employee keeps the money that should have gone back to the non-existent customer. This is creating money from nothing. The cash register generates funds based on a transaction that never occurred. Common method: employee processes small refunds throughout their shift, $23 here, $41 there, never more than $50, to avoid approval requirements. Across a week, that's $500 plus stolen. Across a year, $25,000 plus. The amounts are calibrated to fall below detection thresholds because fraudsters understand policies better than management thinks they do. They know that refunds under $50 don't require manager approval, so they keep every false refund at $49.99 or less. Another variation: employee processes refunds to customer credit cards they control. Instead of taking cash, they refund purchases to their own credit card or to prepaid debit cards. This is harder to detect because the cash register balances correctly. The refund went to a card, not cash. But the refund was fraudulent, the merchandise was never returned, and the employee enriched themselves. Small transactions below review threshold is the key strategy. Most retailers require manager approval for refunds above certain amounts, commonly $50, $100, or $200 depending on the business. Fraudsters stay below that threshold to avoid scrutiny. If the threshold is $50, they'll process refunds for $49.99. If it's $100, they'll do $99.99. The pattern is invisible on individual transactions but obvious in aggregate analysis. Destroying records to obscure the thief's identity involves the fraudster deleting transaction logs, manipulating receipt printers to avoid creating paper trails, or processing refunds during shift changes when accountability is ambiguous. If multiple employees have access to the same register without individual login credentials, attribution becomes difficult. Someone processed a fraudulent refund on Register 3 between 2 and 4 p.m., but 4 employees used that register during that window. Without distinct login IDs per cashier, you can't identify the fraudster. Prevention requires management approval for all voids and refunds above minimal amounts, forcing employees to involve supervisors in exception transactions. Supervisors then verify that customers are present and merchandise is being returned. Distinct login IDs per cashier ensures every transaction is attributed to a specific individual, eliminating ambiguity. Audit refund/void reports regularly, identifying employees with statistically unusual refund activity. Random customer follow-ups. Periodically call customers who allegedly received refunds to verify the refund actually occurred. False void schemes involve employees voiding legitimate sales transactions and removing the corresponding cash from the register. A customer pays cash for their purchase. The employee completes the transaction normally, then voids it after the customer leaves and keeps the cash. The system shows a voided sale, explaining why the register has less cash than receipts would indicate. But the customer has their merchandise and the employee has the money. This is brilliantly simple when you break it down. Customer buys $50 worth of merchandise, pays cash, leaves happy with their purchase. Employee voids the transaction in the system, takes the $50 from the register, and the system thinks that sale never happened. Customer has their merchandise. Employee has the money. Company lost the sale and the cash. The only evidence is the void itself, which seems innocuous. Voids happen for legitimate reasons constantly. Scanned something twice. Void. Customer changed their mind. Void. Price discrepancy. Void. That normalcy provides cover for fraud. You've probably seen cashiers void transactions at stores, and you thought nothing of it because it's routine. That's exactly what fraudsters count on. Voids are so normal that nobody scrutinizes them unless they become statistically excessive. When a cashier has 20 voids in a shift, most managers assume maybe 1 to 2 are questionable, but don't investigate all of them. The fraudster knows this and keeps voids frequent enough to collect meaningful money but not so frequent that they become statistical outliers. The psychological element. Customers don't know their victims. They paid for their items, got their items, and left satisfied. They have no idea the employee stole from the company using their transaction. This lack of victim awareness means the fraud can continue indefinitely unless internal controls catch it. There's no customer complaint triggering investigation, no vendor demanding payment, no obvious missing inventory, just quiet, continuous theft. Analytical red flags make this detectable through data analysis. Employees frequently appearing in top refund/void lists relative to peers warrant investigation. If the same cashier consistently ranks in the top 10% for voids refunds, while peers average far lower, that's a pattern. High deviation from typical refund averages. If peer average is 3 voids per shift and one employee averages 12, investigate. Mismatched customer and refund card numbers. If a refund allegedly goes to a customer credit card, but the card number doesn't match the original purchase card, the refund is probably fraudulent. Prevention requires management approval for all voids and refunds, distinct login IDs attributing every transaction to specific employees, systematic audit of refund/void reports, identifying statistical outliers, and random customer follow-ups, calling people who allegedly received refunds to verify. At a nonprofit gift shop where I consulted, we discovered a cashier had been voiding sales for 9 months. Average voids per shift, 8. Average void amount, $35. Weekly theft, approximately $1,400. Annual theft, over $70,000. Got caught when analytics showed they had 4 times the void rate of other cashiers. Investigation revealed they'd been keeping voided cash systematically. That detection was pure data analytics. No customer complained. No inventory variance was suspicious. Just the numbers told the story. Effective fraud detection requires integrating data from multiple systems to identify inconsistencies and patterns that individual systems would miss. The power isn't in any single technique. It's in combining techniques across schemes to reveal fraud hiding in organizational complexity. This is accounting as investigation, using every data source available to expose what fraudsters try to conceal. Cross-referencing vendors, employees, and addresses exposes shell companies and diverted payments. Compare vendor addresses from AP systems to employee addresses from HR systems. Matches suggest shell companies. Compare vendor names to employee names looking for family relationships or similar entities. Compare vendor bank accounts to employee bank accounts for overlap. Simple cross-reference, devastating to fraud. Round dollar and duplicate transaction analysis. Flags engineered amounts versus natural variation. Legitimate expenses create irregular amounts. $47.83, $134.27, $891.56. Fraudsters often use round amounts, $50, $150, $1,000, because they're estimating or avoiding calculations. Duplicate amounts appearing frequently suggest reused receipts or manufactured transactions. Extract all round dollar transactions, analyze by employee or vendor, identify outliers. Temporal pattern recognition reveals behavioral consistency, distinguishing fraud from randomness. Fraudsters often establish timing patterns, submitting false invoices on specific days, Fridays when AP is rushing, processing fraudulent refunds during shift changes, when supervision is weak, claiming expenses after returning from vacation, mixing fake expenses with real travel. Plot transaction times on 24-hour and 7-day scales to visualize clustering. Identify after-hours activity. Why is someone submitting invoices at 11 p.m. Sunday? Compare transaction timing to employee schedules. Expenses submitted during vacation periods are suspicious. Correlations between financial, HR, and inventory systems create verification networks. Payroll should correlate to HR headcount. Purchase orders should correlate to receiving documents should correlate to AP payments. Sales should correlate to inventory reduction. When these correlations break, fraud often explains the divergence. Employee paid by payroll but not in HR, ghost employee, inventory received per system but not physically present, theft or fictitious receiving, sales recorded but no inventory movement, fictitious revenue. This is the future you're entering. Forensic accountants who combine accounting knowledge with data science capabilities, using analytics to detect fraud at scale. The fraudsters are sophisticated, but so are you. They're creative, but so are you. They're motivated by greed. You're motivated by protecting truth. And the numbers always tell the story. Our job is listening carefully enough to hear what they're saying. So we just covered 5 major categories of cash disbursement schemes: billing fraud, check tampering, payroll schemes, expense reimbursements, and register fraud. That's not just academic theory. That's the playbook criminals use to steal billions annually from organizations that assume honesty until proven otherwise. And if you paid attention, you realize something crucial. Every scheme is detectable. Every fraud leaves traces. Every fraudster makes mistakes. Our job is developing the skills to spot those traces before they become catastrophic losses. Here's what I've noticed. Most business majors learn a little bit about everything. They take one accounting class, one finance class, one marketing class, one management class. They're generalists, but generalists don't detect fraud. Specialists do. Forensic accountants see patterns. General accountants miss because we're trained to look for what shouldn't be there. We find ghost employees by analyzing payroll variance. We expose shell companies by cross-referencing addresses. We catch expense fraud by questioning temporal patterns. We detect check tampering through sequence analysis. That's not general knowledge. That's specialized expertise that makes you indispensable. The market knows it. Forensic accountants have virtually zero unemployment. CPA firms, corporations, government agencies, law firms, consulting practices, everyone needs people who can follow the money and spot when it's going wrong places. Starting salaries for forensic accountants average $15,000 higher than general accountants. Certified fraud examiners with 5 to 7 years of experience commonly earn $90,000 to $120,000. Senior forensic accountants at Big Four firms, $150,000 plus. Why? Because preventing one $500,000 fraud creates measurable value that executives understand immediately. Processing journal entries, while necessary, doesn't generate the same obvious ROI. You came into this class maybe thinking forensic accounting was about catching bad guys like you're in a crime show. That's part of it. And honestly, investigating fraud is infinitely more interesting than reconciling accounts. But the real value is being the person organizations trust to protect their resources. When the CFO needs to know if payments are legitimate, they call us. When auditors need fraud risk assessment, they call us. When lawyers need financial analysis for litigation, they call us. When executives suspect something's wrong but don't know what, they call us. Forensic accountants aren't order takers. We're problem solvers who translate numbers into truth. Real talk about career trajectory. Accounting is already the base layer for business literacy. Forensic accounting is the advanced level. It's accounting plus investigation, plus data analytics, plus communication, plus ethics. You're not just recording transactions, you're interrogating them. That skill set transfers everywhere. Want to work for the FBI? They need forensic accountants for financial crimes investigations. Want to consult for Fortune 500s? They need forensic accountants for internal investigations and compliance. Want to work for the SEC? They need forensic accountants for enforcement actions. Want to start your own practice? Fraud investigation is a thriving entrepreneurial opportunity. Small businesses and nonprofits desperately need forensic services, but can't afford Big Four rates. Here's the strategic play. While other students are worried about finding any job, forensic accounting majors are choosing between multiple offers. While other industries downsize during recessions, fraud investigation work increases because companies scrutinize expenses more carefully when money's tight and executives get desperate. While AI threatens to automate routine accounting tasks, forensic analysis requires human judgment that algorithms can't replicate, pattern recognition, behavioral analysis, ethical reasoning. You're future-proofing your career by mastering skills that are both technical and irreplaceable. Let's connect this content specifically to what we covered. You learned shell company detection techniques that companies pay $300 plus hourly for consultants to perform. You learned check tampering controls that could save organizations hundreds of thousands annually. You learned payroll fraud analytics that eliminated $70,000 annual theft at one organization. You learned expense reimbursement detection methods that recovered $50,000 monthly at another organization. You learned register fraud prevention that stops continuous daily theft. Every technique we covered has direct market value. Organizations will pay you to apply these techniques to protect them. The forensic accounting mindset isn't paranoia, it's preparedness. It's the ability to look at a process and ask, how could this be exploited? Then designing controls that prevent exploitation. Then analyzing data to verify controls are working. Then investigating when data suggests they're not. This systematic skepticism combined with analytical rigor is what separates forensic accountants from general accountants. Anyone can record a transaction. We question whether the transaction should be recorded at all. I'm not recruiting you because our forensic accounting program needs students. We're already at capacity and highly selective about who we accept. I'm telling you this because I've worked in Fortune 500 financial services, manufacturing, nonprofits, and government. I've seen careers succeed and fail, and the common thread among people who build security, mobility, and influence, they master skills that are both technical and irreplaceable. Forensic accounting is that intersection. You just learned how people steal through 5 different disbursement categories and learned how to prevent and detect all of them. But more importantly, you learned how to think like someone who protects organizational resources. That's the forensic accounting mindset. Skeptical but not cynical, analytical but not robotic, protective but not paranoid. Organizations desperately need people who think like this because organizations are constantly vulnerable to people who don't. If you're in another major and something today clicked, the investigation aspect, the data analytics, the practical impact, the career security, the intellectual challenge, come talk to me about transitioning to forensic accounting. If you're already in our program, recognize what you just added to your skill set. Every scheme we cover makes you more valuable because it expands your detection capability and deepens your understanding of how fraud operates in practice. Forensic accounting isn't sexy. Nobody's making TikToks about finding duplicate invoices or analyzing payroll variance. But you know what is sexy? Being 35 years old, making $120,000 plus as a forensic consultant, working cases that actually matter, testifying in court as an expert witness, and having organizations compete to hire you. That's the reality for forensic accountants who master this content. Financial security doing intellectually challenging work that protects organizations and exposes wrongdoing. That's the dream. Cash disbursement schemes aren't academic theory. They're happening right now at companies you've heard of, nonprofits you've donated to, government agencies you interact with. Someone is submitting fake invoices. Someone is forging checks. Someone is collecting paychecks for ghost employees. Someone is padding expenses. Someone is processing fraudulent refunds. And the person who catches them? That's us. That could be you. The why behind the why. Fraud exists because humans respond to pressure, opportunity, and rationalization. We can't eliminate human nature, but we can eliminate opportunity through controls. We can reduce pressure through fair compensation and ethical culture. We can challenge rationalization through accountability and detection. That's our role, not eliminating fraud entirely, but making it difficult enough, risky enough, and unlikely to succeed enough that rational people won't attempt it. And when irrational people attempt it anyway, we catch them through systematic analysis. Write this down. This one travels. Numbers don't lie, but people do. The numbers tell a story. Our job is reading it carefully enough to distinguish truth from fiction. When you master that skill, you become indispensable, because every organization needs someone who can't be lied to with numbers. Every organization needs someone who protects resources while everyone else assumes honesty. Every organization needs someone who sees what shouldn't be there and asks questions nobody else thinks to ask. You learned today what thieves use to steal and what we use to stop them. That knowledge is power. Use it to build careers that matter. Use it to protect organizations that trust you. Use it to expose fraud that others miss. Use it to become irreplaceable. From the past to the present, we account for progress, and when necessary, we account for theft. Class dismissed.